In this video, I'm going to talk about my financial order of operations and how I'm looking at investing more generally. Because ultimately, money's all about priorities. Where are you spending the money? Where is it going? What are you not spending your money on? It's about opportunity cost and prioritizing where you're putting the money in the first place. And my order of operations start with earning active income, and that would be something like my job or my career. In this case, I'm an attorney by day. I make money by trading my time in exchange for legal services. It's a pretty simple model, and it is very active. I need to be involved in the entire process, at least a lot of it, because ultimately people are paying for my advice. And yes, I can hire people below me, but ultimately it does come down to me, and it's pretty hard to scale a legal business anyways, because as soon as an associate starts bringing in their own business, they're probably gonna wanna go set up their own shop. So it's a little bit difficult from that sense. But either way, that's just one type of active income. In general, anything that I'm doing to directly trade my time for money or is otherwise sort of like a job in the traditional sense, that would be in this category of active income. I think a key factor here is that it's not very scalable, but it's very easy to get going compared to some of these other categories that we'll get to, because I have time to give. So I can trade my time, and I've built up my skills in a particular area to where I can get a decent amount of money per hour when it comes to trading that time.
But what I do have are a very particular set of skills.
And I do want to keep investing my time and energy into the skills that allow me to trade my time for a higher price. Or put another way, I'm just trying to be more valuable. But that's just the first step of the order of operations. The second would be investing in private businesses. That is, I would take a significant portion of my actively earned income and spend it towards buying private businesses or reinvesting into the private business that I already own. I own a carpet and steam cleaning business that I bought back in January of this year. Now, you could call the income that I earn from business semi-active, in that I definitely still have to put some effort into things. A lot of it goes into setting up teams and setting up incentives and maintaining things as they go along and making sure I'm keeping tabs on things. But it's not as directly active, or at least required to have my active involvement as my career as an attorney would be, since I'm directly trading my time for money there. With business, there's typically a few levels of separation from that, and that if I put a little bit of time in, it's leveraged across more employees or more systems, or there are things kind of propping up my time in that way. And if all's going well, I'm not actually necessary to run the business every single day. But there are plenty of times when things are not going well, so my active involvement will be pretty necessary. But compared to my active income career, there's a lot more scalability built into owning businesses, because I can hire more people. I can build up a business that sells a scalable product. Maybe it's a service, maybe it's just an individual widget that you can produce more of or buy more of to resell. But the point is, there's a lot of scalability at many different levels, whether that's getting more customers, whether it's providing more services. The point is, my time shouldn't be the limiting factor in the business. And the tax benefits start to play a much larger role here as well, because there are lots of different tax benefits that businesses can get that someone working a job or a more active career probably can't get in many cases. So that is a nice perk, which is something we'll see more of as we move along. Which brings me to the third step, and that is investing the business profits into real estate. I see real estate as a primarily defensive asset, in that if you have a bunch of money and you park it into real estate, at least over the long term, you probably have a lot of inflation protection built in, you can throw off some income, you get a bunch of tax benefits in most cases, so it's really nice for preserving and protecting existing wealth. Not that things can't go wrong, of course, but because of all those benefits, real estate tends to be more expensive per dollar of income that you can make compared to things like private businesses, where you can buy them for 1, 2, or 3 times their annual free cash flow. Whereas with a piece of real estate, typically at best, at least in this environment, you're gonna get it for maybe 10 times free cash flow, though often for quite a bit more. And the opportunities to increase the income on a particular property tend to be pretty limited, although you can invest a bunch of time and energy into a property to increase the income, but at that point, you're bringing even more money to the table. But it is a pretty scalable asset, since if you're buying a bunch of properties in a particular area, you can start getting some economies of scale with management and getting different maintenance deals and contracts, and finding contractors who will work on multiple properties. Maybe you can get some better deals there. And each additional unit shouldn't be all that much extra work, so long as you have some decent systems in place. But when it comes to real estate long term, I see it as a nice way to roll business profits into something that should preserve its value pretty well over time and still be able to multiply it a bit, at least slowly but surely, surely, and that's through principal paydown, appreciation potentially, and the cash flow that the properties will throw off so long as you buy right. But then where do you put that cash flow? Well, let's get back to the order of operations and get to the fourth one, which is rolling the cash flow from the real estate into stocks, commodities, and maybe speculative assets. Now, when it comes to stocks and commodities, I tend to view these more as defensive assets as well, in that they're very good for preserving wealth compared to many other types of investments, at least if you're buying right, of course. Now, it does depend on the sorts of assets and companies that you're buying, because things can get pretty volatile and that can be a pretty big opportunity. But one nice perk with these sorts of assets is that you typically don't have to pay taxes on them while you own them. With real estate, you typically have property taxes, and you're going to have taxes on the income that isn't offset by the depreciation that you get. At least in the US tax code, you can write off a lot of the cash flow. But when it comes to something like stocks, you're not going to have to pay taxes until you actually sell the thing for a gain, at least as things stand right now, and that's not counting dividends that might be subject to taxes. So you can delay your taxes in a big way, and that could be very valuable if you have a big portfolio to park somewhere. But either way, for me, the goal here would still be capital preservation first. It's keeping the money that I already have and trying to grow it at least a modest rate over time, keeping up with inflation and then some if all goes well. But that's how I look at this part of the order of operations. So those are the 4 steps, if you want to call it that, although this really is more of a general guideline I'm following. I'm not following it super strictly by any means, and things will pop up that will be an opportunity that I might want to pursue, so I'll go for that, even if it might violate this sort of order of operations. But I am trying to lean towards this for now, and a lot of my energy is going towards those first 2 steps, and that is earning more active income and trying to up my business income. And eventually the business income should surpass my active income, or at least the amount of active income I could reasonably make. And then at that point, I'd be investing a lot more into real estate. And maybe at some point, the real estate overtakes a lot of what the businesses are making, because I can't stretch myself thin enough to operate a ton of businesses, perhaps. It'll depend on my talents as a business owner. It's a lot easier, I think, to own a bunch of real estate than to own a bunch of businesses. And then much of what's left over would be invested into stocks and all that good stuff. But one thing I should mention is that along the way, there would be reinvestment within each of the categories as well. So for active income, I'd reinvest into getting more skills and trying to find more opportunities to earn more active income. Whereas when we move on to the businesses, I'd be reinvesting into the businesses themselves using the profits that those businesses throw off. So there'd be some self-reinvestment there. Same goes for real estate. The cash flow would be used to pay down extra debt or buy more real estate. So there would be internal reinvestment in all these categories as well. And then the excess would sort of get pushed on to the next step. But really, it's more of a general direction, not a strict rule. And I'm just trying to move towards that direction for the long run, because I think it would be pretty beneficial to have some sort of framework to go off of as I find more and more opportunities and I need to focus more and more. At least it becomes more important to focus because there are just so many things out there to try and pursue. And I guess an overarching umbrella over all of this is that I'd make sure to take care of my personal financial situation first, making sure I'm meeting debt payments and taking care of big expenses that need to be taken care of, and making sure that that is all good and I don't let that derail the rest of this order of operations. And of course, the most important thing I'd make sure to do is to subscribe.